Hello, and welcome back to my YouTube channel. James here as ever for today's ACCA Management Accounting, that's the F2 paper, where I'm going to walk and talk you through a CBE question that you can find directly on ACCA's website, just like you can see on the screen. If this is the first ever video you've clicked on mine, hello there. My name's James, I'm an ACCA qualified member and tutor from the UK, and on my channel I help our ACCA students get qualified for free. So if that's of interest to you, probably because you've clicked on this video, be sure to subscribe so you get access to all of my videos and content at the bottom, because as ever, my videos are all dedicated to my lovely subscribers, and today is no different as ever. As you can see in the screen now, Jathinder, thank you so much as ever for your comments and your requests for important topics on the F2 paper. And in today's video, I'm going to go through an actual MPV question, which is one of the hot topics that you could see on your management accounting exam. So, without any further ado, before we get stuck into the question, the timer is just going to be going through. If you haven't watched the full CBE actual video for this, feel free to check that out. It's also on the channel. But this is a 10-mark question, as you can see on the screen. So in the examination, you'd have 12 minutes to complete this, because you've got 120 minutes in your exam for 100 marks, so 1.2 minutes per mark. So that you can actually have a go at this question before you watch the video all the way to the end, because I'm going to walk and talk you through how I would approach it. I've put the link, as you can see, for the specimen exams in the description of this video below. Go and click on that link. The actual link's in the bottom of this video, as I said, and it's going to take you right there. But without any further ado, with our high budget calculator, as ever on the channel, let's just walk and talk through now. If I had to do this question in the real examination, CBE, just like you've got to do for yours, how would I approach it? Well, first of all, we've got to go through the actual sort of background and scenario analysis as to, before I even, and you can visually see if this came up on your exam, you go, crikey James, 9 points on there, there's going to be a lot of information. Well, hold your horses, first of all. Let's go straight down to the actual tasks and just get a flavour for what they're actually looking for in terms of answers. So we've actually got some nice little drop downs on there. So irrelevant and relevant costing looks like it for task 1. So I'm there going, okay, we've got 50-50 chance. That's helpful on there for 5 marks, but it's going to be linking into MPV. And we've got to be determining whether each of the following costs are relevant or irrelevant based on the project. Then coming on to task 2 now, calculate the following values if the computerized tracking system is implemented. So that gives me a clue there straight away to say, should we go through the project of implementing this computer, yes or no? And we've got sales on here, we've got running costs. The other thing what I'm looking out for is the unit. So you can see on here we've got to the nearest $1,000, but for the first 2 we haven't been given any units on there. So this is a classic thing they will put into the management accounting exam to test you and to actually put you off a bit, is that those sales have to be with the relevant thousands of dollars on there, whereas in actually the third box we can cut that down and we only need to put in the first 3 or so figures depending on our answer. So different formatting, and if you put it in the wrong format you don't get the marks. Right, and then finally coming on to task 3 now. Okay, what have we got here? So we've got a bid on IRR, return on capital employed. Okay, and it links into the computer tracking system again. And we've got to say which of the following is true. So when it says which of the following is true, only one of them is going to be correct down there. If we needed to put down 2 answers, then it would have a big 2 in capital letters to actually guide us on there. And that takes us through to task 3. So really, to get stuck into this now, it's actually just going through these in the background, and if you haven't had a go at this question already, be sure to. But I'm just going to walk and talk it through. Feel free to take some notes, pen and paper, what I'm thinking as a tutor as I read through these style of questions. So in the back of my mind, as we already know, it's a new computer system, relevant or irrelevant costs are going to be here, and we've got to decide, are they relevant or are they irrelevant on there? So maybe have a go before you actually hear me talk about it. But Cabco owns and runs 350 taxis and had sales of £10 million in the last year. Crikey, that's a lot. Cabco is considering introducing a new computerized taxi tracking system. Okay, well that will help out the 350 taxis. But linking into that system now, the expected costs and benefits of the new computerized tracking system are as follows. So this is going to link into those costs that we saw below. So the system would cost $2.1 million to actually implement. Depreciation will be provided at $420,000 per annum, okay, on the actual project of that system. $75,000 has already been spent on staff training in order to evaluate the potential of the new system. Further training costs of $425,000 would be required in the first year if the new system would be implemented. So remember, read through the lines there, analyse it as you're going through. That $75,000 has already been spent before the project. The $425,000 is going to be spent after the project has been implemented on there. Point 4, sales are expected to rise to $11 million in year 1 if the new system is implemented, thereafter increasing by 5% per annum. If the new system is not implemented, sales will be expected to increase by $200,000 per annum on there. So think to yourself, we're going to have a sales figure if it doesn't go ahead and a sales figure if it does go ahead with this new computer system. Despite the increased sales, savings in vehicle running costs are expected as a result of the new system. These are estimated at 1% of total sales. Okay, so we've got some savings on there. Point 6, 6 new members of staff will be recruited to manage the new system at a total cost of $120,000 per annum. Cabco would have to take out a maintenance contract for the new system at a cost of $75,000 per annum on there. Now, another key thing to pick up on, notice how they've got the same figures on there for Cabco, the $75,000 for the maintenance contract and $75,000 for the staff training. So I'll show you what that means for you on the screen, is that when you come down here, notice for task 1, so a student who isn't paying attention and reading the question properly will see, right, 75,000 on here, figure, and then what they'll do is they'll go up and they'll see, oh right, 75,000. That's where it's going to come from on there. They'll read it, they'll put down the wrong answer. You've been warned. Just pop it down there. They put in the same figures for different points to confuse you. Next, for point 8, interest on money borrowed to finance the project would cost $150,000 per annum. And finally, Cabco's cost of capital. Okay, so this is the rate at which they borrow finance to actually put the project into practice, is at 10% per annum on there. So that's the balance between debt and equity and how much it would cost to borrow money and finance. So task 1, in order to determine whether a computerized tracking system should be introduced, indicate whether each of the following is relevant or irrelevant cost for a net present value evaluation. So for anyone who hasn't had a look at an NPV, I would highly recommend you do. And basically what this is an investment appraisal technique that takes all of the positive cash flows, all of the negative cash flows. It then summarizes in each year of the project, is it a cash positive year or a cash negative year? And then we would discount those future cash flows to the present value, and it would say an NPV positive or an NPV negative. If it's positive, we should go ahead with the project. If it's negative, we should reject the project on there. And these costs on here, what we're saying now is, should they be included in that NPV as a positive or negative cash flow? And try to think about it logically as you go through. Okay, and what I would be doing is, first of all, just reading through this, then going back up to the notes, going through it one by one. So the computerized tracking system investment of $2.1 million, as we can see back up here, the system will cost $2.1 million to implement. Well, if you don't actually implement the actual tracking system of $2.1 million, then how is the project meant to go ahead? So I'm afraid to say that has to be relevant on there, because if we don't have it, we can't go ahead with the project. The next thing we have is depreciation of $420,000 in each of the 5 years on there, and that related to point 2. Now this is where you've got to think about depreciation and say, right, what do I know about depreciation? And you've got to say to yourself, what kind of, I don't want to give it away, is depreciation, better way of putting it, is depreciation at $420,000 a cash flow item or not on there? And you should be saying to me straight away there, James, no it isn't. Depreciation is a notional value that we calculate. It's involved in the actual calculations for the income statement within the actual financial statements, but from a cash flow perspective, from an NPV point of view, that is irrelevant because depreciation is a notional amount on there. We've got to be careful as we're going through this that we've got the staff training costs of $425,000 now, and I'm just going to be showing you on the screen where that relates to. So there is our $425,000, and this is relating to the further training costs of $425,000 would be required in the first year if the new system was to be implemented. So again, if we want that system to be implemented, this cost would have to be incurred, otherwise it wouldn't function properly and it wouldn't be fit for purpose so that it would generate the positive cash flows on there. So that, my friends, is definitely relevant for us. The next thing we have is new staff total salary of $120,000 per annum. And that relates to those 0.6, the 6 new members of staff that will be recruited to manage the new system at the total cost there of $120,000 per annum. So in a nutshell, without those 6 members of staff, would the project be able to go ahead and function and operate effectively on there? And the answer you should be giving to me there is, no, James, if we don't incur that, that is definitely not going to help. So that is where it's definitely a relevant cost that we need to incur the new staff coming in, and we need to factor them into the actual project. Now, the staff training costs of $75,000. So as we said, that is not linking into the new system down here. It's the $75,000 that it is in 0.3. So you see on here how they went from, first of all, going from a 0.1, then 0.2, then 0.3, then 0.6, then back up to 0.3 for the 75,000. Notice how some students would make a mistake here. And also, equally as important, the 75,000 had already been spent on staff training in order to evaluate the potential of the new system. So this has actually happened in the past, and the key term to get down in your notes is that that 75,000 is a sunk cost and is not relevant to the project moving forward on there. It's happened in the past, it's not relevant moving forward, and is therefore a sunk cost. So hence it is irrelevant, and we get the mark for it. Finally, coming on to the interest costs of $150,000 per annum, and that is again down to 0.8 on here, that the interest on money borrowed to finance the project would cost $150,000 per annum. And I know what you're thinking there straight away. You're going, right, James, if we borrowed some money to actually get this project up and running on there, and we've had to pay some interest, surely that would be factored into as a cost on there. And logically, as a student, you'd go, that is probably a negative cash flow. Well, I'm afraid to disappoint you, that it is actually an irrelevant cost that we shouldn't factor in. So this is where it's going to demonstrate a student who understands the actual net present value investment appraisal technique effectively and what it means putting into practice. So make sure we get this jotted down on here, that the interest on the money borrowed is actually factored into that cost of capital there. So this is where in that 10% that in an NPV calculation, we take all of our positive cash flow, all of our total cash flows, for each year, we total them up, and then we discount those by 10% each year, and that gives us an NPV figure once we total them all together to be either positive or negative. So the interest on the money borrowed is actually embedded and factored in to the cost of capital at the 10%. So hence the 150,000 is actually irrelevant on there for you as well. Now, as we're going through, if you've got any questions, I probably should have mentioned it at the start of the video, leave me a comment at the bottom as well. Let me know how you get on with the video as well. But we're going to come on to task 2 now, where this is where you're going to have to be having your calculator with you as well. But again, just try to picture what's going on with a computerized system, and these are simple marks for you to pick up on. So task 2, calculate the following values if the computerized tracking system is implemented. So notice me putting emphasis on that, so that you get to think about, right, the computerized tracking system is going to be implemented. So first key term for you to get down here is the incremental sales in year 1. And what that means is that if we just went and actually had no computer system, what would the sales have been? Versus if we actually put that computer system into place, what are the sales going to be with the computer system? So think about it like that. Incremental sales is the difference between the sales with the computer system and without the computer system on there. So let's put it up on the screen so you can see how we can factor this in. So if you think about it in year 1, and remember, year 1 being asked for, we were told that their sales are expected to rise to $11 million in year 1 if the new computer system is going to be implemented. And this is where your question analysis comes into it and is so important. So now we've got to say, where have we seen about the actual, well, if we don't go through the computer system, how much are the sales going to be? Well, we know that they had sales of £10 million last year, and then we're actually told within the notes that sales, so if the new system is not implemented, sales would be expected to increase by $200,000 per annum. So what we're saying there is that in year 0, last year, we had sales of $10 million. So in year 1, we're going to add another 200,000. So would you not agree that, if we come down to it now, that we would have 11 million, just got to be careful with my zeros on this now, 11 million is for the sales with the computer system, minus, and this is where our 10.2 comes into it. So we had the 10 million, I'll bring it up so you can see it, there's where the 10 million comes from, on there, and then we've got the 2, 1, 2, 1, 2, 3, there we go, so there's your 10.2 equals 800,000 in the incremental sale. So that is the difference between taking on the computer system and if we didn't go through with the computer system. Now notice as well 800,000 on there, and this is where to the nearest 1,000 was in the bottom one. So in this box you would have to then write 800,000 in there. So be careful with your actual number of zeros, and you don't need to put in any commas or anything like that. Address the answer how the marker is wanting you to present it is the key thing to get in your notes from that. Then coming on to the next point, we have sales in vehicle running costs in year 1. And this is where, as you can see, we've got to go back up. Think about where the vehicle running costs were as you go up. And let me pull it up here. We will need the calculator again. So despite the increase of sales, savings in vehicle running costs are expected, let me just clear this so we get it right, are expected as a result of the new system. These are estimated to be 1%, okay, of the actual total sales on there. And it said sales in vehicle running costs in year 1. So remember the sales in year 1 were $11 million. So again, just pop it in. And this is where you've got to be careful with your actual decimals. I'm trying to multitask now, talk to you and do the calculator and do the screen. So bear with me. Right. So there's our 11 million multiplied by the 1%. So that is where you've got to be careful just on your decimals to get it down right. So that is saying to me that we're going to make a saving of $110,000 per annum, okay, based on those vehicle running costs on there. And again, notice it's not asked us for with the thousands of dollars on the end. So I've got to put in the full figure on there, 110,000. So let me just do it with you on the screen. Oh, 110, James. There we go. There we go. Spot on. Okay. So we've got it in the correct format on there. Now taking into account for the next one, we've got to the nearest $1,000 on there. So we were asked the present value of the maintenance costs over the life of the contract. So again, that's 75,000 on there that we have to refer back to. So this is where, if you go back up to point 7 now, so Capco would have to take out maintenance contract for the new system at a cost of 75,000 per annum for 5 years. Okay, so this is where it's in simple terms, all it's saying there is the maintenance contract would be £75,000 per annum for 5 years into the future. So what we're looking at there is to say, well, okay, how much is that? I'll pull it down back here. In terms of the present value as at today. So this is where you've got to get familiar with the time value of money to say that 75,000 each year, every year for 5 years into the future is not just 75 plus 75 plus 75 plus 75 plus 75. We have to discount and bring those £75,000 to the present value, taking into account two factors: time, so the number of years, and the cost of capital. And this again is another classic management accounting question that is going to show up a well-prepared student or not. So the alarm bells should be ringing to you when I say cost of capital, number of years, in the future to bring back to the present value, that we're going to have to use another thing that is given to you within the examination. So if you go down to the references down here, and I'll pull up the calculator as well, so that we have it. And this is where you're going to have to use something called an annuity table on here. So this is where you get given these tables, and I'll just pull it over here so I'm still in your screen. So you get given these tables, as you can see on the screen. Now, the key thing to get down for your notes of this is that the discounted rate table, the present value table, where, can you see they're all going from 0.99 for 1% all the way down to the zeros are getting smaller. Basically, if you multiply any number by this, it's going to make it a smaller number. It's going to discount it to the present value as at today. So this is used within NPV calculations on there, also linked into IRR, but it's not what we're after, because remember, we've got those 75,000s going for 5 years into the future. And this is where you need to have used the actual annuity table. So notice for the annuity table on here, the numbers are getting bigger because they relate into the future on there for a future value, brought actually into taking those amounts from the future back to the present value. And that's the difference between the annuity table and also on there the present value table. So you've now got to say to yourself, we only need to take one of these numbers on here, but which one is it? So coming back to the actual question, remember we had the actual figure that we know is 75,000. We've got it for 5 years at a cost of capital of 10%. So again, just head back onto the annuity table on there, and I'll pull up my calculator for you. So there's my 5%. I'm just going to move the calculator out of the way so we can get it on here. There's my 5% where the mouse is. There's my 10 years on there. So we've got on there... Oh no, hang on. James, you're just demonstrating why students muck up on this exam, okay? I can hear you say, James, no, it's 10% at 5 years. So there's the 10%. It's just the originality of the channel on here. Even I get it wrong sometimes as to, there's the 10% for 5 years. So we need to be using that 3.791. That is our annuity factor that we're going to be using. So 3.791. So let's put it in, 3.791. And what you're going to do there is multiply it by the 75,000. So what that is doing for that 3.791 is saying that we've got the cost of capital at 10% over the 5 years, and this is now going to tell us the present value of those 5 years of 75,000 on here. So let me just pull it down for you on here so we minimize it. And it's not gone to any decimals, but it's where the examiner will actually be favourable to you, where we have the nearest thousands. So if you're a bit off, maybe we can try it on the screen now. So my answer is 284,325. So 284325, 284325, and that, as you can see, gets me the correct tick. But because it's to the nearest thousand, different people may actually calculate it, maybe using more decimals on there. It depends. So let me see if it will give it on a 6. As you can see there, it would still mark it correct. So just, if I was you, follow the tables that they actually give you on the platform and do it that way if I was you, rather than trying to do it the manual way, which you can also do on there. But for me, time saving, use the PV factor tables on there for the annuity and walk and talk it through there. But after that entertaining stumbling block, we now move on to task 3. And this is where Cabco wishes to maximise the wealth of its shareholders. So for your notes, what that means is they want share price to go up and dividends to go up for those shareholders. They are the equity owners of the business. It has correctly calculated the following measures for the proposed computerised tracking system project. Okay, so this is how they're actually going to measure it. So they've got the internal rate of return at 14%. The return on average capital employed is at 20%, so what the money they're actually getting back. And the payback period is 4 years on there. So these are the measures for the proposed computerised tracking system project. And we're asked which of the following is true for it. Okay, and it's all about maximising shareholder wealth for it. So the project is worthwhile because the IRR is a positive value. Well, okay, well that's all good and true, but the IRR 99.9% of the time is always going to be a positive value. It doesn't link into actually saying, is it going to maximise shareholder wealth for us? So I'm ruling that one out straight away. It's not specific enough on there. The project is worthwhile because the IRR is greater than the actual cost of capital. Now that is interesting because this is where it's going to show up your actual investment appraisal and understanding the time value of money, that the IRR for your notes, the answer of 14%, at that 14%, that indicates to me that the NPV of the project is 0 on there. So if you have a look, if you want to do some research on it, have a look at a interpolation diagram for IRR, that any actual percentage of IRR, for any percentage of IRR less than 14% is going to give a positive NPV project on there, okay? Because for the IRR, for your knowledge on it, to actually get to it, we need to take a cost of capital figure, and it's going to give us a positive NPV, and take another cost of capital figure, and it's going to give us a negative NPV. We then interpolate between the 2 points, and that's where we come to the 14%. And so if we have anything lower than the 14%, that's going to give us a positive NPV, and hence that's going to give us a positive return on the project. So as far as I'm aware, that is good for investors and shareholders. But let's have a look at the other two, because we've always got to rule out other options. So the project is not worthwhile because the IRR is less than the return on capital employed. Well, that isn't true because, let's rewind on that, because the project is not worthwhile because the IRR is less than the return on capital employed. Well, it is worthwhile because, yes, the return on capital employed is bigger than the IRR, but the return on capital employed is a better measure of actually maximising the shareholder wealth for the shareholders, because that is based on capital employed, so and the money that's been put into the business. So in terms of the project is not worthwhile because the IRR is less than the return on capital employed is not true at all. It's like comparing apples with oranges on there. It's the return on capital employed is referring to the debt and equity of the actual business, which we're talking about from the shareholder's perspective, whereas the IRR is all about the project specific on there rather than the entity overall. And so that's not true. Which of the following is true? Is the project, so the fourth option now, the project is not worthwhile because the payback is less than 5 years. Well, that isn't true on there because the payback is 4 years on there. So the project is not worthwhile because the payback is less than 5 years. Well, it says the payback is 4 years. on there. So that is not true for you, I'm afraid. So it can only be the project is worthwhile because the IRR is greater than the cost of capital. There you go, 2 out of 2. But just to reiterate on that, is because we've got the IRR at 14%, and it's saying that the IRR is greater than, so the 14% is higher than the cost of capital, which was at 10%. So what that is saying to me is, at 14%, the NPV is 0. Anything less than that, at 10%, which we have for the cost of capital, that is going to give us a positive NPV on there for the project, and hence is going to maximise the wealth of its shareholders. Whew. Well, that takes us through question number 36 on the section B for the CBE exam. I hope you found that helpful, me just walking and talking it through. Hopefully got some good notes as we've gone through, and if you're watching at this point of the video, I'd really appreciate it as ever, and thank you so much for all the support for the channel. Be sure to give it a massive like and thumbs up below. Also, feel free to subscribe like Jathinder. Leave me any comments below, how you get on with your exam. Any other requests, I'm more than happy to support, because I know these can be the little differences, those little marks that can be the difference in getting you that 50 plus and passing your management accounting F2 exam. But as ever on that bombshell, we'll see you next time. Cheers.